Investment firm RisCura is one of the global leaders in frontier and emerging markets. And I'm pleased now to welcome its founder and chief investment officer, Jared Hansberg. Jared, we know that we're dealing with extremely low interest rates and expansive monetary policy and concern about rising inflation. Tell me, what does this mean for European pension funds?
If you look at interest rates, say 20 years ago, they were obviously a lot higher, and those interest rates have come down, and that really has blown out liabilities. So you've seen liabilities, the liability side of the balance sheet of all pension funds really go up. And that there puts a strain on funding because you need the assets to catch up. What inflation does is inflation actually raises the amount that you have to pay anybody in, let's say, 10 years' time. So if it's 100 euros without inflation, then if you suddenly have 1% inflation over the next 10 years, it will be 101 euros. So inflation really starts to push up the requirements. Now, when you discount those to today, that really is going to be the key in establishing what the funding level is of European pension funds. But low interest rates have put a strain on it. Inflation will put a strain on it. And unless interest rates go up, which really serves to counteract that inflationary problem, you would get to a place where actually there's more strain on funds.
So where does that leave us on the asset side of the equation?
The asset side is interesting because remember, RisCura, a purpose-driven firm, when we look at these things, we're looking at both sides of the balance sheet, and we're looking at them both live as we're discussing now. And by that, I mean the live liabilities can be discounted and understood in today's terms using today's market rates. The same thing can be done for assets. So if the liabilities really are put under duress because of inflation and interest rates, you can be guaranteed the same thing is happening on the asset side. What's actually occurred in all of this is that asset prices through low interest rates have actually expanded, just as liabilities have. So you've got very high asset values, and those become far more vulnerable. And the inflation story is obviously good for earnings for the assets. So if you have equities or companies around the world, then inflation is good for the earnings component. But the problem is when you discount that to today at a higher interest rates, should interest rates go up, then unfortunately what you're going to see is market values of assets come down.
So how do you go about investing, and what are some of the things you need to bear in mind?
So when you're in emerging markets or frontier markets or even alternative assets, things like liquidity is important. So you need to worry about asset-specific issues. There's a lot more due diligence on those assets. There's more due diligence on the managers that you employ to actually help you with that. And then once you move out of that, there are macro issues. So governments, economics of countries. And what RisCura found very important there is geopolitics. I mean, geopolitics has driven a lot of the decision-making that we've made over a very long period of time. But all of these areas, the alternative and the frontier and emerging market space have got, the risks are far more amplified than you would find elsewhere. And so there's a lot of due diligence in all of these areas that you are required to do.
Of course, environmental, social, governance factors are all front of mind for global investors. How do you approach these concerns?
The first thing to point out is that there's no place in investments anymore for irresponsible investing. So everything needs to be responsible. And ESG, as you said, environmental, social, governance issues are crucial. All investors have long lived with things going wrong, and RisCura looks at this and tries to understand all of this for the different areas that we're involved in. So if, for instance, if you're looking at ESG in an emerging market, you need to be concerned about the specifics of that market. So an issue for someone in Delhi would be a social issue for someone in Delhi would be very different to something for someone in downtown Frankfurt. The second thing is on climate. I mean, different places of the world are affected differently by climatic issues. So, for instance, the whole of Southern Africa, Namibia, Botswana, Zimbabwe, and South Africa, are impacted more by global warming than, let's say, Europe. It's climatic and it's geography, but essentially, if you get a 1 degree rise in temperatures worldwide, well, 3 times that occurs in Southern Africa. This is the kind of research that you need to do. What you would do then is you would structure the ESG to suit all of those countries. You need to be specific, and it's important to actually build in, and it's important to build it in an intelligent way. You can't just use sweeping statements and sweeping approaches.
Okay, Jared Hansberg, many thanks for joining us. Thank you.